Hello, everyone, and welcome to Financial Accounting with Anne Marie Anderson. Today we will be talking about the income statement, which is the first of the four financial statements. An income statement is a financial report that shows a company's revenue, expenses, and net income over a specified period of time, basically showing how well a company performed and how profitable they were. It can go by several names, so profit and loss or P&L, statement of operations, statement of earnings, or revenue statement, all the same thing. Let's start with a single-step income statement, which shows the company name, the title of the statement, and the time frame covered in the report. Reports can be prepared monthly, quarterly, but at the very least annually. The single step shows all revenues minus all expenses and is more commonly used in service businesses like salons, lawn care, attorneys, and even accountants. That's me. Single steps are easy to prepare and understand. They're helpful for small businesses and quick performance analysis. However, they lack detail on operating versus non-operating, which we'll cover in a minute, and the single step provides limited insight for decision-making or performance analysis. On to the multi-step, which is far more common with larger businesses. For this one, let's pretend we've got a donut business. We start off the same way with the title of the company, name of the statement, and time period covered. Let's take it line by line, starting with sales revenue, which reflects all the sales of my donut business, my primary operating activity. From sales revenue, we subtract cost of goods sold, which is basically the cost of making the product. That would be things like flour, eggs, oil for frying, packaging, and even the salaries of my bakers. That leaves us with a very important number, gross profit. Gross profit shows how much we actually earn from the sale of our donuts. But we don't stop there. Now we have to subtract all of the other costs of running our business. These are called operating expenses and are broken down to selling and administrative expenses. Selling expenses are things like the costs involved with running a store, from electricity all the way to depreciation on that store. And don't forget the salaries of our salespeople. Administrative expenses are the cost of running the business. So if we had a separate office where people like the CEO, human resources, and payroll work, those are administrative costs. After subtracting all the operating expenses from gross profit, we have a subtotal, income from operations, which shows all the profit the company earns from its core business activities. This is really the number to look at to determine how profitable the business is. Then we get into the other category, which includes income or expenses from non-operating, not core business activities, like interest income or expense, or gains or losses from selling capital assets. It's still related to our business, but it is not part of our core donut-making business, so it's classified as other. That leaves us at our next subcategory, income before taxes. Income taxes get their very own line item because it isn't a controllable expense. It is what it is, so the number gets reported on its own. Finally, we're at net income, which shows all the revenues less all the expenses of running the business and would be the same whether we were using the single or multi-step income statement. The multi-step simply gives us more information with the way the expenses are represented. We use net income in many of our financial analysis calculations. The multi-step gives us a detailed breakdown of revenue and expenses and highlights key subtotals like gross profit and operating income, which ultimately gives us better insight into company performance. It is more complex and time-consuming to prepare than single step, and for non-financial people, it might be hard to interpret, as well as being overly complicated. Earnings per share. Earnings per share is a financial analysis measurement that is required to be shown on a public company's income statement and is a basic measurement of a company's profitability. The formula for earnings per share is net income minus any preferred dividends divided by the number of common shares of stock outstanding. Earnings per share shows us how much net income is earned for each share of common stock outstanding. Great, we're done with the income statement, but where do we go from here? The net income from the income statement is used to prepare the next required financial statement, which is the statement of retained earnings. This is why we have to start with the income statement because we need that number to move forward. That wraps up the income statement. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.